Today on our podcast, we can talk a little bit about mortgages and kind of get behind the scenes of interest rates because everybody loves this. This is a software called Loan Sifter that you can only get if you're licensed as a mortgage person. And what it does is we have many investors that we sell loans to. This takes in all their pricings and figures out who's got the best price or shows you each individual lender and what they offer for something. So to give a quick example, let's go through this. This is a $1 million purchase price on an $800,000 loan with a 740 credit score, 30% debt ratio, U.S. citizen, and 90210. So it's Beverly Hills. And so let's click submit and see what the rates are. Isn't this cool?
Yeah, last week we had Glick predicts. Now it's Glick submits.
Glick submits. There you go. So today on a 30-year fixed, and you see all this stuff, and I'll explain this. These are the interest rates. So you see they go from 7 down to 6. I'm going to skip this for a second. This is the price for those rates. So you see, if I'm going to offer you 7%, that means the lender's going to pay 102.12, 2.12% of the loan amount, which is $800,000, and going to give you $16,960 towards closing costs. But if you take, and let's ballpark it here, 6 3/8, the lender will give you an eighth in rate. That APR, annual percentage rate, is 6.389. So it's basically you get $1,000 towards closing costs on a fixed rate of 6.375% for a 30-day lock. So you could see all the different variations. It just happens to be that Sierra Pacific's one of our lenders, and they're really aggressive, but it shows all our other lenders and what they have. But let's modify this search and do a new one. And let's say you're looking for a $500,000 loan, but we want to do this as a conventional refinance, rate and term, meaning just paying off the current loan, maybe rolling in the closing costs, but not taking cash out. And let's change it to a 15-year fixed. So it goes here. Let's see what we get. Whoop, forgot something. Sorry. Property value, form, boom, submit. So now 5.75 gets you a rebate of $4,385, which should cover closing costs and might be at 5.625, APR 5.661. You get $2,670 towards closing costs. So you see how this all works. So we could scream out, hey, we have a low 15-year rate of 5.25 with a 5.396 APR. And you see how much the APR is higher than the rate. That's because you're paying 0.713 to get that low rate, or $3,565. So that's how we find out rates every day. Now you see it sneaks in. Flagstar's got the best at 6%. And 5.5 and 5.375, but Sierra Pacific is the best at 5.25. So this helps us as a broker to figure out what's the best rate for you and what's the best rate they're paying. Now, it might be that Sierra Pacific does something that the other lender doesn't do, and so we have to use them for some reason, but this is pretty much vanilla. So you can see the rates have come down too. So we're in the 5s on 15-year fix. Now, just for fun, let's modify it again and do
that was a 30-year fixed, wasn't it?
That was a 15-year fix.
Oh, okay.
Let's do an ARM, and let's do it for 5 years and see if a 5-year ARM's any good. No, nobody's got anything good. So, the ARMs are not around. They don't really. Let's just see 7s because we're in, here's the 7 years. Now remember, what do we have on you could get a 7-year ARM at 6 1/8 and get a rebate of $25.80. So let's compare that. Go back to the 30, plain 30 fixed. It's at 6.125 with a little bit of with 2,500. So it's 6.375. So it's 0.25% better to get a 7-year ARM. So you see, this is how we price rates. The other cool thing is this is connected to our website, and you can go on our website anytime and get live rates. And this is what you'll get. It's exactly the same thing we see. So pretty cool stuff. Oh, also give you the principal and interest payment too. Not your taxes and insurance. So that's it. I just wanted people to kind of know what we look at, what the rates are. This is as of today, 224.25. And always make sure when you're looking at interest rates and you're competing 3 or 4 companies, do it exactly at the same date, same time, because tomorrow rates will be different. The way it works. So there's your quick primer on interest rates.
That's very interesting. And also, if you do go to arrivva.com/rates, you can see the live rates, but you can also subscribe to have those rates updates emailed to you.
Yeah, sent to you whenever they change, which is great. You keep an eye, hey, I need to get to 5 for it to make sense. Just wait. The day it hits 5, you bing, make the application calls, get rocking and rolling. So another thing we do is we don't charge for credit reports until the closing. A lot of companies might charge you for credit reports up front to run all your stuff. Oh, and one of the other things, because everybody freaks out. Oh, I don't want you to run my credit. My credit score is going to tank. Well, here's the story. If you're a 750 credit score and I run your rates and you do it with 5 other companies on the same day, they only take 5 points off, 3 to 5 points. It's something nobody knows exactly. But you can kind of have this 1 to 2 week window of searching for interest rates, and you're not going to get hit on every time it's clicked. And plus, what does it matter if you lose 5 points? Are you going to go out and pick up 17 credit cards and 14 car loans tomorrow? No, you're not. So you just got to do it. Just bite the bullet and do it. It's a little bit of a thing, but it's the only thing that we got. But it's not that bad. Because, people imagine that, oh my God, my credit's going to tank. No, it doesn't work that way. So there you go.
They wouldn't be able to take it too much. I mean, otherwise no one would ever apply for more debt or a loan.
Exactly. You couldn't get it.
How long it lasts?
I forget.
I mean, usually the first thing when you first apply for it, it hurts you the most. And then every month increment a couple points. So realistically, it's not going to hurt you more than 4 months in a kind of amount that it's going to really affect you. Right. And here's the other thing, right? Like I think as a culture, we're so in our mind, it's like, oh, I want to have a high credit score. I want to have a high credit score. The whole reason why we want to have high credit score is so that we can apply for these mortgages. So once you're ready to buy a property, it shouldn't be something in your mind of like, oh, I don't want it to hurt my credit score, because that's like your main focus. It should be your only main focus. Once you're on the housing market, you should not be applying for anything else, right? And if you're thinking about doing that, unless you have $3 million in the bank, you're making a big mistake, right?
Right. Get that furniture after you close.
And then buy a house?
Yeah. Yes. Pretty much.
Going off of the pre-approval process and interest rates and all that. I mean, so I'm dealing with getting my sister pre-approved for a VA loan, right? And this just happened like in the last 48 hours. And one of the things that happens is she's working with a mortgage broker, and she says 99% of my deals are VA loans, and I never fully underwrite my clients, and they never have to waive the contingency, right? So it's one of those things where it's really important for you to understand as a consumer that just because someone tells you to not go through with the entire process, you should really kind of develop a sense of oh, why should I do something? Why shouldn't I do something? Right? Because we're going to say something?
I was going to say something it's that loan officers tend to think they're going to run the transactions. Loan officers are not licensed to be real estate brokers. They do not know what's going on in particular markets. They do not know what negotiation tactics you have to get under contract, like a fully underwritten pre-approval. That's because they don't want to spend the money for the underwriter to fully underwrite fully underwrite the loan because it's a loss leader for lenders. So they'll lie to you.
Yeah.
And I've even had mortgage approvals given to me and worded in a way that it sort of seemed like it was fully underwritten, but it wasn't. It was a complete lie, and they lied to the consumer. If you're in a market that has multiple bids and everybody's waiving the mortgage contingency, you better get a fully underwritten pre-approval. I mean, we'll let you do it without it, but you're going to sign a form saying you understand you could lose your deposit.
But it's not even about competitive markets, right? I mean, here you're dealing with a market where, let's say you're dealing in a market where everybody has a mortgage contingency, where everybody has a VA loan. Well, guess what? If you are different than everyone else, where you're fully underwritten, where you can waive everything, where you can have a clean deal, and let's say both offers are at the same price, who are they going to accept? They're going to accept the offer that has done the homework and done a lot of the back end stuff to make sure that you're clear. You might even get a better deal because of that, right? So people call us and ask us, oh, what else are you going to use to help us get under contract? Well, one of the best things to do is to be over prepared and get everything other than price out of the way. And
you have to do this anyway. That's what I understand about people. Oh, I don't know. I don't want to do it.
Well, the problem is commission. The problem is that we're in the commission-centric industry, right? And nobody gets paid until it closes, right? So that's why, I mean, if it were up to me, I'd abolish the commission system, because that's why mortgage brokers don't want to do their job, is because they're not going to get paid until it's a done deal, right? So why should they do it? Or have someone else do it, and then they can run rates later, right? So
I'm talking about the consumer themselves saying, oh, I'll do it later. It's not a, blah, blah, blah. You're going to have to do it anyway. So get it out of the way.
Sure. I mean, some buyers say, oh, I don't want to do it right now. But a lot of the time it's because someone else told them, hey, you don't have to do it. But the person that said, hey, you don't have to do it is incentivized financially to not really over prepare you. Right. So that's kind of the whole kind of story there. Anyway, that's what I've been dealing with the last couple of days. I've tried to tell them, like, hey, look, can you just get it done? It's like the mortgage broker keeps fighting with me, and I'm just like, look, you know what? I'm asking you to do this. Will you be able to do it or not? Or do we have to go somewhere else?
Is this California?
Oh yeah, this is in San Diego.
Hey, we can do it. We do it.
I don't really look into what we do mortgages stuff, so I figured
René, Pérez, NMLS license, ... You might use all this.
No, I'm licensed, but I don't.
You're great. The guy who works for the company doesn't even ask. Yeah, for his own sister. Nice. Yeah, we can do it. We have a couple of lenders. They'll do any pre-approvals for anything. So, yeah, no big deal. No big deal.
Question on the fully underwritten pre-approval. So I saw like it was like a 30-day rate lock. When you get a fully underwritten pre-approval, how long is it good for?
90 days, because it's the credit report, the pay stubs, the bank statement have a shelf life. So that's why it's 90 days.
Okay, so 90 days seems pretty long.
The credit report, I mean, but that's what they've chosen. So
no, that's good. That's good.
We're just following the guidelines of the lender.
They can still re-verify your things once you're under contract, right? So
yeah, they might get an updated pay stub or that kind of thing. Yeah.
Let's talk about this Glick predicts. Glick, what's your prediction for this week?
Oh no, mine was so major. It's taken a little time. Well, you see, the rates have come down already, so the recession has started slowly.
Yeah, we're recording these two episodes pretty much a couple days apart, so not much has happened. Yeah, but I can tell you the market has not been very good. The stock market's been down ever since Glick predicted the recession.
Yep.
Rates are down.
And even the what do you call it? The crypto's tanking too. So Rams in the low 90s, I think.
What is? Oh, Bitcoin. Yeah, well, I see that Ethereum's down 24% today, or for the month. For the month,
Bitcoin is at 92,000.
It's been in that range. Yeah. The Winklevi made a lot of money. Let's put it that way.
At $30 they bought it at 30, right?
Nothing. They bought it like years ago.
Yeah, at $30, I believe, was when they entered?
30? I thought they got it like $5. I thought
maybe
they took their Facebook lawsuit winnings and made it into gazillions.
And speaking of crypto, you can now pay your fees via crypto.
Yeah.
Red, if you've got some Bitcoin you want to use.
There you go. It's not part of our buyer broker agreement because it says dollars, but I got to change. I got to do an addendum. Do you want to do it in crypto? So
one thing that I noticed, I was stripping a listing to go on the market next month. And it actually had, maybe it's been like this for a while, but I noticed that there was a box to say like seller is willing to accept cryptocurrencies, which I thought was pretty cool.
In the listing contract?
Not in the listing contract, but in the MLS.
Oh, in the MLS. Yeah. Okay. Especially in that Bay Area.
That's interesting.
Will this hurt real estate? Are people saying, okay, I'm not going to buy because my crypto didn't go up enough, so I can't sell it? And, there may be a couple of people dropping out. It's not going to make a big deal.
I mean, I'm pretty sure it's hurting somebody because a lot of people were waiting from 2021. All the prognosticators were saying come January, February, March, it's going to be the bull run. It never was. So we're in this delayed bull run. So that's all those people are waiting to cash out and maybe buy a house or, try to see somewhat like the top. That's not there. And so, yeah, I could see it hurting the market.
Well, I think in our case, it's people will sell maybe, but they may have to borrow more. Instead of borrowing $1 million, they borrow $1.5 million because they can afford it. So, I mean, we're lucky. We're in a market, California and Washington State, where people can afford things, no matter kind of what the economy is either. But like Florida, forget it. There ain't nothing you should touch in Florida, especially if it's a condominium. It's just, I don't care if the condo is perfect and they have every dollar. The value is going to come down on even the good stuff because the bad stuff is so bad. And there's people walking away from houses. All these people bought all these Airbnb things, and it's sad. It's just completely collapsing for multiple reasons. So we were licensed to do mortgages down there, but I don't think we've done any this year.
No,
I know we learned nothing.
And the biggest thing about Florida that you've mentioned in past episodes is that I forget the term. The condos have to have that impound or the
reserve study. Yeah. And the state law that came into effect, that basically is the same. They have to have enough money in reserves and all that stuff, and they don't have it. So we're going through one of a potential listing with clients who they bought a house through us, and now we're listing their association, their condo. The association has 5 units, and that's the minimum that you need the reserve study for. It's self-managed and by some guy who thinks he knows everything. And, and the bottom line is you got to get the reserve study. And the question was, well, what if there's a shortage? Does everybody have to pony it up right up front? The answer is no. You have 24 months as part of, extra money to put into your monthly payment. So if everybody's paying 150 and there's an extra 25 for 24 months to get the reserves up to the number. So you got to do it, because if not, the value of your property will plummet because no one will be able to get a mortgage. So you're now this many buyers becomes this many buyers because you got one person with cash and they're going to lowball you because they can. So 5 units or above, you've got to get that reserve study done. And that's all across the country. And there's 2 companies out there who are doing the reserve studies. We haven't really directly used anybody, so I can't recommend anyone, but they're out there. Just Google them or chat them.
Is this something that the association hires to do the reserve study?
Yes. So, and they're also, every condo association is cheap. They don't want to spend any money, or they spend ridiculous amounts of money on things that they don't need to spend. Remember, it's a nonprofit. It's not there for profit. But the problem is you got a property manager who's been there forever, uses only his guides. Prices are a little inflated. You got to worry about this stuff, and you got to get a different auditor. That's the thing. That's the number one thing you ought to do if you suspect any problems. Get a separate outside auditor. Don't use the same accountant that the property manager told you to use.
Sure.
That's the worst thing you can do.
And what about for units like a condo complex with 4 units?
You're okay. You don't need the reserve study.
But those four,
2, 3, and 4 units. You still have to be in good shape and all that kind of stuff. And but there's other rules for the small condos.
But you don't have to.
I mean, so you don't have. It's one of those things where like you don't have to have anything, but it would still be best practice to have something, right? Because
of course
you're going to have to paint, especially if it's a older property, or if you're on the lookout for an older property, you have to think about, okay, are the CCNRs all set in stone? Is there any funds to paint the house, the roof? Who's going to deal with this? Because if you're buying into an old property with 4 units and you know you're going to need repairs, it's going to be a headache to get people to pay to get termite done, because everybody has to agree, right? If you do termite treatment for your unit, it's not going to be as effective as if you do the entire development. So you need to make sure that whoever the HOA is or whoever your neighbors are, they're going to be willing to pay up for all the necessities of the community. And if there's no money in it, that means that as soon as you buy in, you're probably looking into everybody having to pay up an assessment to be able to afford the expenses. So yeah, that's the risk. That's why I say HOA, no, thank you. Might as well be mostly a renter.
So what are some good questions to ask for someone that might be looking at these smaller like condos with 1 or 2, 3?
Ask for the budget. See what the monthly payment covers. Make sure there's insurance on the property. Ask who's running it and what their qualifications are. Because sometimes, people, the condo fee is only $94. Yeah, but they're not paying for anything. They're not paying for professional management. They're not even paying for insurance, which they have to have. And, it's just but the cheaper it is, usually the worse it is. So the high, we see a unit with a high condo fee, you don't really worry about it as much as the ones with the small amount. So people just see the number, but don't know the context, our favorite word behind it. So context of condominiums.
I don't know if this is specifically for small developments, but let's say you're in your mid-20s and you're kind of still saving up for that down payment. And you know exactly where you want to live, or your family is going to stay in that particular development or that area. One thing to maybe do is, and it's always best when time is on your side, is to maybe go to the board meetings of those developments, see exactly what goes behind the scenes, because you can ask all the questions you want, but unless you're really informed and on the ground, looking into what the HOA management is and what the community thinks about the development, I'd say that you can't really believe what's in writing, right?
Yeah, thanks for mentioning that. Because you're allowed to get, when you buy the place, the minutes of the last couple of years of meetings that you want to look at. That's when the decisions were made. But René knows now, I've known for years, that going to a condominium association meeting is worse than killing yourself. It's just the worst.
Yeah. No,
it is people who, this is their highest amount of power they will ever have in their lives. I volunteered to be president of my condo association. So I'm going to do this. I'm going to do that. And it's just like, horrible.
I do have a question. For buyers, but what about people that are living in it? Let's take a duplex, for example. It's a two unit condo with a common area. I know fair housing, you can't discriminate, but if someone's buying that house, the other person in the unit has no say as to who buys it.
Correct. Yeah, that would be a co-op, not a condo.
Okay, so a co-op, they could still have some say as to, which
if you're undesirable, let's say it's a New York co-op. I mean, they're famous for this, and I don't know, what's your name now? Yeesh. So one of these just idiots decides he wants to buy in the co-op. Well, they have an interview with him and they do a background check, and because they don't want issues. I mean, they got a lot more flexibility in a co-op than they do a condo, especially in New York. It's insanity. So
well, that makes sense. So if you might consider that if you're selling one side of your duplex.
And then there's what's called tenants in common buildings in California. We could do an entire show on that. So we're just not going to go there, but that's kind of sort of the same thing, but worse. That is the worst form of pain in the ass stuff and documentation and the way you can buy it and PIC, co-op, condo.
Okay.
So that's ascending.
You need to as a buyer, you need to be aware of what you're buying into and the differences.
You bet. You bet.
It's interesting. I learned something today.
And also there's this ratio of condo price to condo fee. You'll see a lower price on a unit. Oh, this is only $550. And the place across the street is $650. Well, I'll just buy this $550. Well, you notice the condo fee's $2,200 in the lower price one and $800 in the other one, or something like that. Oh, there's a reason. There's always reasons for all of it. So that's kind of the thing. Be aware.
Fascinating.
There you go.
René, anything top of mind for you?
I'm looking. So actually, I do have something top of mind. So I'm looking at a roof inspection, and something that I had noticed for maybe the last 4 or 5 inspections, I didn't really think of it as a big deal just because technology is so advanced these days. But when you're doing inspections, one of the good inspections to get is a roof inspection. They offer drone inspections where the drone just takes the images of the entire roof. For the most part, I mean, it's really high definition images, and you're able to tell in general whether a roof is in good or in bad condition. Mm-hmm. But a drone inspection will never fully replace someone being, inches away from the roof. It's more dangerous, and it's why a lot of these companies are shifting into drone inspections. But if you are getting a roof inspection, ask them if they will actually go on the roof, because that can make the difference between you being able to get a credit from the sellers to the sellers saying like, "Hey, the inspection looks good. Bye."
Well, we ought to really talk to a roofer about this, but maybe they put the drone up, and then if they see something that's questionable, they can go up on the roof and have a further inspection. Would that work? I don't know.
Now, you know what? On the ground, inspections keep honest people honest. Let's just say that.
There's also a tactile thing that you can only tell once you stand on the roof. Like a drone's not going to tell you whether the roof's springy or the sub underlayment is solid.
Mm-hmm.
Okay.
Not that I would just think that being there, physically feeling it and walking on it.
Yeah.
A lot more.
Sure. The drone can't feel.
I'm sure. So actually, I'd say that we're not there yet where we have a drone for the retail consumers where you could actually kind of do a temperature gauge and do the entire actual, kind of the feel of the actual roof. But I'm sure that the military has drones that can, just by looking at it, check on the temperature and see the stability of the roof and all that. So I'm sure there is, right?
But thermal footprint.
Exactly.
Yeah, to see if it's steel reinforced. So if they drop a bomb, they got to figure out which bomb to drop. I guess that's probably the use or something like that.
Yep. No, I'm sure.
Sure. We probably just let out a Pentagon secret and after FBI would be
go to a neighborhood
5 minutes. There you go.
And another news, while we were on the call, we got a offer acceptance from a property that we made, an offer we made in Tacoma, Washington. So it's Monday. Yeah.
Well, that's good.
Keep on rocking. Yeah, it's busy now, and the rate's starting to come down. It's going to get busier, and like I predicted before, the refis are going to start soon. Mm-hmm. So,
well, especially in what we were saying, it was like 5.35, 5.65 at the loan.
Yeah, on the 15 year, it was like 5 3/8, I think it was.
So if someone bought their house in the last year at 7.25 or 7.75, it's going to make sense.
Yeah, even on a 30 year, if you're in the sevens, and I did that pricing of a property value of $1 million, loan amount of $500,000. 740 score. We came out at 6.125 with $1,280 rebate and an APR of 6.147. So yeah, 6.125. Or was that the 7-year? No, that was the 30-year fix. And the 7-year was better. So
is there a magic number for a rate decrease that you're going to want to then it's a no-brainer?
In the old days, it was 2%, but that was based on a $100,000 loan. So look, you got to look at, here's the thing. So let's say you borrowed $600,000 3 years ago, and it was at 7.5, just to make up a number. I'm just making up numbers here. But now your balance is down to, $50,000 less. So the payment is going to be less at the lower interest rate, even at an 8 lower, because it's at a balance. So you got to do the mathematics and figure it out. But also you got to think to yourself, do I want to restart a 30-year mortgage? The lower payment's nice, but now you're restarting a race. Maybe you look at taking the 30-year loans, always can be done at a 25-year term, same rate. So if the numbers work for 25, hey, okay, then I'm still saving money, and I'm not restarting the race. Maybe I gain a couple years. They also do 20-year mortgages, and obviously 15 and 10. Rocket does any year you want. You want a 22-year mortgage, they can do that. That would be at the 25-year price. So again, you got to play around with it a little bit. How long are you going to be in the house? Do you want to, I remember in the old days, we used to pay 4 points, roll them into the loan, get the lowest rate. You had so much equity, it didn't matter. You got to think about this. You might want to say to yourself, look, I just want to get a super low interest rate. I'm going to pay points. I'm going to throw them into the loan amount, and I'm using the equity in my property that I've gained because it's appreciated to help me get a lower payment. So every single person is completely different based on what their situation is. So that's why obviously you want to talk to a mortgage person. It's not going to just, when you call and say, what's your 30-year rate? Oh, it's 6.9. No, that's the worst guy you ever want to talk to. It's like, give me all your information. Let's figure out what's going to work for you. So it's that term, it's that payment, it's a whole bunch of little things, how long you're going to be there, what your goals are. So talk it out as the refinance starts. You got to ask all the questions.
So would you say now, Fred, instead of since rates are going lower, it would be easy to assume that it's good to get a adjustable mortgage and just refi in a couple of years?
Yeah, you get the 7-year, which is better than the 30-year.
Yep.
And you also, by the way, there's no prepayment penalties on owner-occupied mortgages in the United States, period, done, end of sentence. That was done through Dodd-Frank, but I don't know if Dodd-Frank's going to survive the year, and that may change. So you can refinance and then refinance again. They just kind of go through it. If your value is under $1 million and you have, say, at least 20% equity, 999 value, 780 mortgage, and your credit score is great, your income's great, you might get it with no appraisal. They have appraisal waivers, which is great. That makes things so much easier. And they're talking about slowly rolling out a situation where instead of paying title insurance again for the lender, because the lender gets title insurance for themselves, not for you. The title insurance you got when you bought the property covered you from the day you bought it on back in time, that nobody's going to pop up and say, hey, this is my property, not yours. The lender now says, 2 years later, hey, we need to know it's still a clear title. They get title insurance going back. But there's this alternative to title insurance that's working through attorneys where they just do the searches and they give them a letter saying, yeah, everything's good. That's going to save people money. So it's not out there big in the public yet, but it's slowly the cost of refinancing has come down. To get an appraisal waiver and one of those attorney letters, it's going to be super cheap to do it. Each lender is going to have a fee, like around $1,200. They call it an underwriting fee, $1,000 to $1,200, somewhere in that area. Then you have your tax service fees, flood search fees, that kind of stuff, notary fees. The notary person's got to see you sign it. They get a fee, credit report, so there's a few bucks to it, but literally, I had people like every 6 months would refi on 15 years as it kept going. I think I did it 3 or 4 times.
Really? Yeah.
Yeah. So it's crazy.
And during the last rate reduction, we refinanced.
Yeah. Back in
we
2000.
did 3 times.
Yeah. In like 21, between 20 to 22 in that area. Yeah. It was nuts. Kept dropping and dropping.
I guess, yeah. As soon as we got the mortgage, the guy was back with it's lower. You should do it again. I'm like, we just did it 2 months ago.
Yeah.
So it made sense. I think we got in right at the bottom. We're at like 275.
Mazel tov.
They also, then you're locked in. It makes it kind of hard to do anything. You don't want.
Yeah, now's the problem. Hey, we need a bigger house, and rates are 7. It's like, I don't know. Everybody just sleep closer together or something. Like, deal with it. Yeah, that's a big decision for people. But here's the beauty: if you can afford it, you keep that property as a rental. Oh my God, you're with the rents having gone so much higher, you can pay it like it's 10-year. You can have a 30-year mortgage and pay it like it's a 10-year. Just apply more towards principal. And every month, it's the opposite of compounding. Every month, they calculate the outstanding principal balance at the rate for the remaining term at the payment you're paying. And that shows how much more is going to go towards principal. So a lot of, it's a great way to accumulate equity if you're lucky enough. So,
well, Brett is giving a masterclass on mortgage rates today. Yeah, this is pretty interesting. I learned a few things.
It's what we try to do here at Arrivva.
Fix real estate, fix mortgages, and predict.
Okay.
Everyone can go home.
Bye.
See you later.